Breaking news, the very latest central bank move this morning. The Bank of England, as expected, raising its benchmark rate by 50 basis points. That comes after what we've heard from so many other central banks this morning. Steve Leisman joins us right now with what's already been a pretty busy day for monetary policy on the heels of what the Fed did yesterday. Steve?
Yeah, no sleep for central bank reporters here because it's moving around the world, Becky. And I want to tell you that the Bank of England was a close call here. It was 5-4, all 9 voting to raise rates, but 3 of them wanted to go by 75. There was a lot of talk in the market about the possibility of 75. The base case was 50. The Bank of England did deliver on that, but also talked about asset sales and their concern with the government's energy price guarantee over there fueling inflation. This is a potential issue throughout Europe where governments may come in and try to subsidize energy prices there, and that creates an inflationary problem for central banks. We do have this move around the world in response to the Fed's big move yesterday, and also in part a result of their own inflation problems here. Take a look. The Swiss National Bank up by 75 basis points, Norway up by 0.5 point, Indonesia as well. Japan unchanged, but the first currency intervention since 1998, all this coming after the Fed's third 75 basis point increase and signals of more to come, more than markets expected. Remember, markets had already previously ratcheted up their own outlook. The Fed out-hawked the hawks on this one. Fed hiked its outlook for the funds rate this year to 4.4%. 4.6% next year, topping market expectations significantly. Fed Chair Powell said he thinks it's likely the Fed actually hits that forecast.
We've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook and ask ourselves whether our policy is in the right place as we go.
In response to my question, which came off of some of the comments that Barry Sternlicht made on our air, Powell said there may come a time when the Fed stops and waits to see what impact its hikes are having on the real economy. But he said that time is not now, Becky.
Yeah, Steve, we spoke with Roger Ferguson this morning, and he made a lot of interesting points on this. Just the idea that the market is waiting for the Fed to pivot. As soon as they do, it's going to try and take advantage of it. I mean, Powell's in this position where he has to not just talk tough, but continue to do the tough things because some investors weren't believing what he's been saying for a while.
Yeah, I think that's right. Roger obviously is 100% correct. It's the idea to sort of put blinders on or somehow draw a ring fence around the idea that there's any a possibility of the Fed wavering in its rate hikes. And so it comes forward with this very, very hawkish outlook for policy. And then Powell puts a stamp on that by saying, yeah, we're probably going to hit that. Remember, sometimes the Fed chair says, oh, those forecasts over there, they're not what we mean. They're just the result. But he really has embraced these forecasts now and using them as a tool of policy to convince the market how much conviction, how much a dedication the Fed has to raising rates and stamping out inflation despite what could be that negative fallout. So he is not going to stop, at least according to his answer to my question, not going to stop to look around and look for those things that Barry was talking about on our air.